All right, everyone, welcome back. Today we're tackling a topic that I know can be a real headache for CFA Level 2 candidates.
Multinational
That's
operations.
the one. But honestly, it's also super interesting once you get past all the jargon.
Absolutely. And it's crucial for understanding how global companies really operate.
So what exactly are we diving into today?
Well, we'll be covering all those tricky foreign currency transactions, figuring out how to translate foreign financial statements, and we can't forget about how these impact a company's ratios and taxes.
Yeah, those tax implications can be a real wild card. But you know what I love most about these deep dives? The real-world examples,
Oh, absolutely. We've got some great ones lined up today, too.
like Nestle, BMW, Heineken, companies everyone knows. It's way more engaging than just staring at formulas in a textbook.
Totally. Seeing those concepts in action is what makes it all click.
Okay, let's jump right in. Imagine a Finnish company importing electronics from Mexico. Euros, pesos. How do they decide what currency to use?
Well, the buyer and seller have to agree on that. Could be either of their currencies, or even a third one like US dollars.
Okay, makes sense. So let's say they go with Mexican pesos. Does that mean the Finnish company now has like a currency gamble on their hands?
It definitely introduces that element of risk, because exchange rates are constantly in flux.
Yeah, like what if the peso strengthens against the euro between when they ordered the stuff and when they actually have to pay up?
That's exactly what we call foreign currency transaction exposure. The Finnish company would end up paying more than they originally planned in that case.
Meaning they take a loss, right? And if the peso weakens, they get a gain.
You got it. It's like an added layer of uncertainty on top of the actual business transaction.
So how does this actually get recorded in their books? Do they just wait till they make the payment and see what happens?
Not exactly. IFRS and US-GAAP have rules about reflecting the most up-to-date economic reality.
Wait, are you saying they might report gains and losses on transactions that haven't even happened yet?
It might seem counterintuitive, but that's the idea. Let's say our Finnish company placed the order in November, and their balance sheet date is December 31st.
Okay.
Even if they don't pay until January, they still have to recognize the gain or loss based on the exchange rate on that balance sheet date.
So they're basically marking their books to market for these foreign currency transactions.
Yep, it's all about reflecting the economic substance, even for transactions that haven't settled yet. We call it an unrealized gain or loss.
Okay, I'm starting to see how this gets complex fast. So where can analysts actually see how much these currency fluctuations are affecting a company?
Companies will break this down in their financial statements.
Okay, so like in the footnotes or something.
Right. You can see the magnitude of those gains and losses, get a feel for their exposure. BASF and Heineken do a good job of this, for example.
This makes me think about all the strategies companies use to manage this risk. They're not just sitting ducks, are they?
No way. Hedging is a big one. Think of it like insurance against those big currency swings.
Ah, smart.
Nokia is a great example. They actively hedge using things like forward contracts and options. It's essential for them, being such a global player.
Okay, so we've covered individual transactions. But what happens when a company has subsidiaries all over the world, each operating in its own currency?
Now, that's where translating those financial statements gets really interesting.
Yeah, consolidating those has got to be a nightmare.
It's a massive puzzle, constantly changing shape. We have different currencies, fluctuating exchange rates, and then we have to bring it all together into the parent company's presentation currency.
All right, help me untangle this. Say we have subsidiaries in Brazil, Japan, and South Africa, all reporting in their local currencies.
Okay, so first, we have to figure out each subsidiary's functional currency. This is basically the currency of their main economic environment, like where they earn and spend most of their cash.
So for our example, the Brazilian subsidiary would likely be using the Brazilian real, Japanese subsidiary the yen, and South African the rand.
Exactly. It's their home currency, so to speak.
All right, so once we've got that, we can translate everything into the parent company's currency.
Right. But there isn't just one way to do it. We have the current rate method and the temporal method.
Two methods. Okay, I'm already sensing a but coming here.
Yeah.
They can't both be that straightforward, right?
Well, the current rate method is probably the more intuitive, like taking a snapshot of the subsidiary's balance sheet on a specific date. We translate all the assets and liabilities using the spot rate for that day.
So if a subsidiary has 1 million Brazilian reals in assets, and the current exchange rate is 0.25 euros per real, those assets would be 250,000 euros on the consolidated balance sheet. Simple enough.
So far, so good. But there's a catch. We use historical exchange rates for equity item?
Historical, meaning?
The rate that existed when the equity was initially invested. So we're mixing current and historical rates, which can create some interesting effects.
Okay, it's definitely getting trickier. And I'm guessing the temporal method is even more fun.
Think of the temporal method as focusing on preserving the original measurement basis of those assets and liabilities.
Ah.
For things like cash, receivables, payables, we use the current exchange rate, just like the current rate method. But for non-monetary assets like inventory or property, plant, and equipment, we use historical exchange rates.
Wait, different rates for different types of assets? This is starting to sound like a recipe for a major headache.
It can be. And the choice of method can significantly impact those translated financials. It even means things like the inventory costing method can impact the translated cost of goods sold.
Oh boy, so how on earth are we supposed to make sense of all this?
Well, examples always help.
That's what I was hoping you'd say. Hit me with a good one.
Let's take this case study from your materials. It features a Europe-based company called Interco, and they have a subsidiary in Canada, Canadaco. Interco's presentation currency is the euro.
Okay, so we're dealing with euros and Canadian dollars. What's Canadaco's balance sheet looking like?
They've got cash, receivables, inventory, property, plant, and equipment, all denominated in Canadian dollars. They've also got some payables and a long-term loan.
Gotcha. So, first things first, we need to figure out Canadaco's functional currency.
Exactly. If it's the Canadian dollar, we'll use the current rate method. If it's the euro, we'll use the temporal method.
Let's say it's the Canadian dollar for this example. Walk me through the current rate method.
Okay, so we'd take each balance sheet item and translate it using the current exchange rate on December 31st. Let's say that's Mo 0.80 euros per Canadian dollar.
So if Canadaco has 980,000 Canadian dollars in cash, that becomes 784,000 euros on the consolidated balance sheet.
You got it. And we do the same for receivables, inventory, all of that.
Easy peasy. So everything gets translated at that 0.80 rate.
Well, almost everything. Remember those equity items? We use the historical exchange rate for those?
Ah, right. The rate from when the equity was initially invested.
Precisely. Let's say that was 0.70 euros per Canadian dollar. So if they have 1,500,000 Canadian dollars in capital stock, that translates to 1,050,000 euros on the consolidated balance sheet.
Okay, so we are mixing those rates, just like you said earlier.
Exactly. Now, if we were to use the temporal method instead, things would look quite different, especially for those non-monetary assets.
Because the Canadian dollar might have strengthened against the euro throughout the year.
Right. Using those historical rates could lead to a different translation adjustment, one that could even impact the income statement.
Okay, my brain is officially starting to hurt. But I'm definitely seeing how the method used can really change things.
And that's why it's so important for analysts to get this, because you might be comparing two companies, one using the current rate method, the other using the temporal method.
And you need to be able to account for those differences to make a fair comparison.
Exactly. It's not just about understanding the mechanics. It's about using that info to make smart decisions.
True, true. Okay, so we've tackled foreign currency transactions, these translation methods. What else can trip us up when we're looking at multinational companies?
Don't forget about hyperinflation. That's a whole other beast.
Oh yeah, where prices are basically doubling every other week.
Something like that. It definitely adds another layer of complexity when we're translating financial statements.
Okay, before we get into that, can we define hyperinflation? Like, is there some sort of official threshold?
Both IFRS and US-GAAP have their own definitions, but essentially we're talking about situations where cumulative inflation hits 100% or more over a 3-year period.
Yikes, that's intense. How do companies even function in those environments, let alone try to translate their financials?
It's challenging for sure, but there are special rules in place to make sure those statements still give a fair representation of what's going on.
Okay, that makes sense. So what's the IFRS approach in these crazy scenarios?
First, we restate the foreign subsidiaries' financial statements for local inflation.
So we're adjusting for those changes in the general price level?
Exactly. Bringing those numbers into current economic reality, so to speak.
It's like giving them a much-needed reality check. Then what?
Once we've restated for inflation, we translate using the current exchange rate. That way, we're capturing the impact of both the insane inflation and the fluctuations in the exchange rate.
Okay, so we're accounting for both of those wild factors. But you mentioned US-GAAP does things differently.
Right. Under US-GAAP, we don't restate for inflation. We use the temporal method to translate the statements.
So it's like we're pretending the subsidiary is operating in a stable currency, even though it's in the middle of all this chaos.
It can definitely lead to big differences in those translated financials, especially compared to the IFRS approach.
To see how different maybe a real-world example would help.
Absolutely. The materials you gave me highlight Turkey's insane inflation back in the early 2000s.
Okay, perfect example. Let's say a U.S. company had a subsidiary in Turkey back then. How would those translated financials look different under IFRS versus US-GAAP?
Let's say the subsidiary had a piece of land on its books, purchased for a certain amount of Turkish lira back in 2000 when the exchange rate was favorable. Fast forward to 2002 after all that hyperinflation.
And the Turkish lira is basically tanked against the US dollar.
Exactly. So under the current rate method, what IFRS would use after restating for inflation, we'd translate that land at the current, much weaker exchange rate. The land would be worth a fraction of its original US dollar value.
Oh,
But under the temporal method, what US-GAAP would use, we'd use the historical exchange rate because land is a non-monetary asset.
hold on. So the land would still be reported at its original US dollar value, even though the Turkish lira plummeted. That doesn't seem right.
It might seem counterintuitive, but that's how the temporal method works here. And that's why it's so important for analysts to understand these nuances. The choice of method can have a massive impact on a company's reported assets, equity, even earnings.
It's like comparing apples and oranges if you don't know what method is being used.
Exactly. You have to adjust for those differences to make any kind of meaningful comparison.
Okay, we've done foreign currency transactions, these translation methods, and even touched on hyperinflation. What else should we be thinking about when analyzing these global companies?
Taxes. When companies are operating in all these different countries, things can get pretty complicated pretty quickly.
Oh yeah, I can only imagine the tax headaches.
It's not just about the tax rates in each country, it's navigating all these different systems, transfer pricing, tax treaties, double taxation.
Wow, okay. I'm already overwhelmed. Maybe we can cover some basics so our listeners don't completely freak out.
Absolutely. One of the most important things to understand is transfer pricing.
Which is?
It's all about the prices related companies charge each other, like for goods, services, intellectual property, things like that.
So if a parent company sells materials to its subsidiary in another country, the price they use is the transfer price.
Exactly. And here's why it matters. This can be used strategically to shift profits from higher tax countries to lower tax countries.
Ah, I see where this is going. So a company could lower its overall tax bill by playing around with these prices.
That's the general idea. But of course, there are rules to prevent companies from getting too creative. Most countries have regulations based on the arm's length principle.
Meaning?
The prices between related companies should be similar to what unrelated parties would charge in a comparable transaction.
So no making up random prices. It has to be a fair market price, essentially.
Right. Tax authorities are always watching to make sure companies play by the rules.
Makes sense. But even if they are, it still seems like there's a lot of room for interpretation.
Absolutely. Determining that arm's length price can be pretty tricky, especially with things like intangible assets, patents, or trademarks. There are different methods, and it often involves a lot of economic analysis and documentation.
Sounds like a job for the tax specialist. But even if we're not experts, it seems like we should at least be aware of this concept. So how can analysts see how transfer pricing is affecting a company? What should we look for in the financial statements?
That's where the effective tax rate comes in.
The effective tax rate.
Yeah. It's the actual percentage of a company's pre-tax income that's paid in taxes.
So it's not just about the tax rates in each individual country.
Right. It captures the overall impact of all their tax planning strategies, including transfer pricing, credits, deductions, all of that.
So generally, a lower effective tax rate means the company is more tax efficient.
Exactly. And it can fluctuate from year to year depending on things like changes in tax laws, where their profits are earned, and those strategic decisions we talked about.
Okay, so this is definitely a number worth paying attention to. But where do we find this info?
Most companies provide a pretty detailed breakdown in their financial statements, usually in the footnotes or the MD&A.
Oh, good. So they're not just giving us a single number. They're explaining how they got there.
Right. They break down the different factors, including those related to foreign operations. It's really helpful for analysts trying to understand a company's tax position.
This is making me want to go back and look at some companies' financial statements with fresh eyes. I never really focused on those effective tax rate reconciliations before.
It's definitely worth a closer look. By analyzing those and understanding transfer pricing, you can get some great insights into a multinational company's financial health.
Okay, so we've explored foreign currency transactions, the crazy world of translating foreign financial statements, and even dipped our toes into multinational taxes. What else should we think about when analyzing these global companies?
Well, amidst all this talk about translation and taxes, we can't forget about sales growth. Those foreign currency fluctuations can have a big impact there, too.
Right. A lot of these companies generate tons of revenue from overseas markets. And we already know about those accounting challenges of translating that back to their reporting currency.
Exactly. When a company's reporting currency strengthens against the currencies where they're earning revenue, those foreign sales translate into fewer dollars or euros, even if the actual sales volume hasn't changed.
So their reported sales growth could be lower than their actual growth if we don't consider those currency movements.
Precisely. It's like a hidden drag on their performance.
Kind of like an optical illusion. The numbers might look good, but they could be inflated by a weak reporting currency.
Exactly. And on the flip side, a strong reporting currency can hide a company's true growth potential.
Okay, so we need to look beyond those top-line numbers. How can analysts adjust for this and get a clearer picture?
That's where we use the concept of organic sales growth.
Organic sales growth, is that like some new age, eco-friendly metric or something?
Not quite. It's basically a way to filter out all the noise and focus on the pure growth that's coming from the company's core operations.
So we're taking out things like acquisitions and divestitures, and those currency fluctuations we were just talking about.
Exactly. It's isolating the growth that comes from real increases in sales volume or prices, not external factors.
Okay, that makes sense. Are companies required to report this? Will we always see it in their financials?
It's not a mandatory GAAP measure, but a lot of companies provide it voluntarily.
Because they know investors want to see it.
Right. They understand it's a key indicator of their underlying performance.
Makes sense. Any examples of companies that do a good job of highlighting organic sales growth?
Procter & Gamble is a great example. They always break down the impact of volume, price, and foreign exchange on their sales.
Okay, so organic sales growth gives us the real story. But what about the risks? How do we assess those when it comes to all this currency volatility?
That's where a company's risk management strategies come into play. Remember hedging.
Like those forward contracts and options?
Exactly. Companies use those to try and minimize the impact of these swings on their earnings.
It's like insurance against those currency fluctuations, right?
Perfect analogy. And some companies are more proactive than others. It really depends on their risk tolerance, the volatility of the currencies, all of that.
So how do we figure out how much risk a company really has? And if their hedging strategies are working?
Company disclosures. Some will even give you sensitivity analyses in their financials, showing how earnings would be affected if exchange rates move.
Wow. So they're basically saying, what if this currency strengthens by 5%? What if it weakens by 10%?
That's the idea. They'll give you a range of scenarios and quantify the impact. EMW does a really good job of this.
That's super helpful. It's like getting a peek behind the curtain at their risk management.
Exactly. By digging into those disclosures, we can get a much better understanding of their financial health. It's all about connecting those dots.
I'm feeling like a multinational operations detective. We've got organic sales growth and sensitivity analyses. What other clues can we find?
You know, there's one more concept that's important for financial analysis. The difference between clean surplus and dirty surplus accounting.
Okay, those sound intriguing, but also a little confusing. What's the difference?
It's about how certain gains and losses are reported. With clean surplus, all gains and losses, realized or not, flow through the income statement. So everything hits net income eventually.
Okay, so what makes it dirty?
Dirty surplus accounting allows certain items to bypass the income statement and go straight to the equity section of the balance sheet.
Like those unrealized gains and losses from translating foreign currency statements.
You got it. They don't directly affect net income.
And while that's allowed, it does make things a little tricky for us analysts. We might not be getting the full picture of profitability, right?
That's the issue. It's like we're missing part of the story.
So what's the fix? Is there anything in the statements that can help?
Both IFRS and US-GAAP require the statement of comprehensive income.
Comprehensive income.
Yep. This statement captures all the changes in equity, including those that bypass the income statement.
So it's a more holistic view.
Exactly. By looking at it, we get a much more complete picture, even if it doesn't directly impact that bottom line.
This is so helpful, like getting an extra set of financials to work with.
It's a powerful tool for uncovering those hidden gains and losses.
Okay, so we've talked about how the functional currency impacts our analysis. Can companies actually change their functional currency once they've set it?
They can, in certain situations. IFRS and US-GAAP have rules about when it's appropriate.
So it's not a decision they make lightly.
Right, because it could mean restating their past financials.
So what would make a company decide to switch things up?
Well, a major shift in the subsidiary's primary economic environment is one common reason.
Okay, so like, what if a U.S. company has a subsidiary in the U.K. that's always done most of its business in pounds?
Right, but then they expand into mainland Europe and start making most of their revenue in euros.
Ah, so their financials would be more accurate if they were presented in euros at that point.
Exactly.
Makes sense. Anything else that might trigger a change?
Hyperinflation. IFRS and US-GAAP allow and sometimes even require a change in those cases.
Right, back to those crazy economic conditions.
Exactly. In those situations, the local currency can be so unstable that switching to a more stable one makes more sense.
This really shows how interconnected all these concepts are. Currency transactions, translation, hedging, taxes, even the functional currency.
It's a giant puzzle, that's for sure.
And the choices companies make about their accounting and reporting can really change how we interpret their financials.
Absolutely. That's why it's so important for analysts to really understand these concepts.
This has been an awesome deep dive. We've covered so much today.
This has been a whirlwind.
I think our listeners are walking away with a much better understanding of how to handle all this, whether they're prepping for the CFA exam or just making investment decisions.
Absolutely. And remember, this is a constantly evolving field. So keep learning.
Couldn't have said it better myself. And with that, we'll wrap up this deep dive into multinational operations. Until next time, everyone, it makes you realize there's always more to learn.
For sure. And that's what makes this field so exciting. Always something new to discover.
Speaking of new discoveries, I'm curious about those sensitivity analyses we talked about.
The ones companies provide to show the potential impact of exchange rate movements.
Yeah. How can analysts use that info to make better decisions?
Well, those sensitivity analyses are like a window into a company's risk management. They help us see how vulnerable they are to currency fluctuations and how effective their hedging strategies might be.
So it's not just about understanding what they're doing, it's about assessing whether they're doing enough.
Exactly. Let's say a company's sensitivity analysis shows a huge potential hit to earnings if the euro weakens against the dollar.
Okay.
But they haven't hedged against that risk at all. That would be a red flag, wouldn't it?
Definitely. It suggests they might not be managing their currency risk as well as they could be.
Right. Or it could be that they have a very high risk tolerance.
Which could be a good or bad thing depending on the company and their overall strategy.
Exactly. The sensitivity analyses give us more pieces to the puzzle, helping us assess the overall picture.
They're like clues that help us understand the potential risks and rewards of investing in a multinational company.
Precisely. It's all about using the info to make smart, informed decisions.
Okay, so we've got these sensitivity analyses to help us assess risk. What about those other risk management tools, like hedging?
Hedging can be super complex with all sorts of different instruments and strategies.
Can we at least touch on some of the basics so our listeners know what to look for?
Sure. Forward contracts are a common one. They basically lock in an exchange rate for a future transaction.
So if a company knows they'll need to buy euros in 3 months, they can use a forward contract to guarantee a specific exchange rate.
That's the idea. It helps protect them from those unpredictable currency swings.
Makes sense. What about options? Those are another popular hedging tool, right?
Yep. They give the company the right, but not the obligation, to buy or sell a currency at a specific price in the future.
So it's like buying yourself some flexibility.
Exactly. They can choose to exercise the option if it's beneficial or let it expire if it's not.
Interesting. So there's a cost associated with that flexibility.
Right. You have to pay a premium for that option, but it can be worth it for the peace of mind.
I'm starting to see how these different tools can be used to manage different types of risk. It's not a one-size-fits-all approach.
Not at all. And the best approach for one company might be totally different for another.
It all comes back to understanding their specific situation, their risk tolerance, and their overall goals.
Exactly. It's like a custom-tailored suit. What works for one might not work for another.
I love that analogy. So we've talked about these different risk management tools, the importance of understanding those sensitivity analyses, and how all these factors can impact a company's financial health. What's the biggest takeaway for our listeners today?
I think the key is to remember that analyzing multinational companies requires a global perspective.
Meaning?
We can't just look at the numbers in isolation. We have to consider the impact of currency fluctuations, different accounting standards, tax implications, and the complexities of operating in a globalized world.
It's like looking at the world through a multifaceted lens, considering all these different angles.
Exactly. And the more we understand these concepts, the better equipped we'll be to make informed decisions, whether we're investors, analysts, or just curious about how global business works.
This has been such an insightful deep dive. I feel like I've gained a whole new understanding of the multinational world.
Me too. And I hope our listeners feel the same way.
We've covered so much ground, from those basic foreign currency transactions to the complexities of hedging and risk management.
It's been a whirlwind tour, but hopefully a fun and informative one.
I think it's safe to say that we've all leveled up our multinational operations knowledge today.
Absolutely. And that's what these deep dives are all about.
And on that note, we'll wrap up this episode. Until next time, happy analyzing, everyone.